Washington Journal continues.
Welcome back. We're joined now by CNBC's Maria Bartiromo. Thank you for joining us.
Hi there, Juana. Thanks very much.
We just want to start off by talking a little bit about the big deadline we hear about for resolving this budget impasse and the debt ceiling is October 17th. That's tomorrow. But what does it actually mean? What happens then?
Well, I think that's a great question because there is a lot of misinformation out there. Tomorrow is the date that Treasury Secretary Jack Lew said that the government would run out of money and be unable to pay its bills. Now, technically speaking, really the deadlines are a lot later than that. For example, there is an interest payment due, but it's small and manageable, about $6 billion, due on October 31st. And then on November 1st, the government has non-debt obligations. In other words, it has to pay Social Security checks, government employee salaries. That's on November 1st. That's being looked at. But the bigger interest payment is on November 15th, and that's more than $30 billion in interest payments. So even though tomorrow is the deadline that many people are talking about, actually we do have a little more wiggle room beyond tomorrow. And it really is end of the month, October 31st, with that $5.9 billion debt payment, November 1st with the non-debt obligations paying government workers, Social Security payouts, and, of course, the bigger one, as I mentioned, November 15th. Very few people are expecting this to go past November 1st into, really threatening that important debt payment, which is $31 billion on November 15th. So that's really the layout for the next couple of weeks. But, of course, hearing the Treasury Secretary say that the U.S. is running out of money tomorrow should be enough fire to actually get these two sides together to make a plan so that we're not dealing in the 11th hour on October 31st or November 1st or November 15th.
So then not the chaos that some people are suggesting if there's not a deal made today.
That's right. The chaos really has to do with the reaction from the markets. Because let's say the perception out there is that the U.S. is running out of money tomorrow. And there is a perception because Jack Lew said it, and, that's what people are expecting, October 17th. So if the markets have a disruption and we see a dislocation and stocks sell off and bond prices plunge and interest rates soar, that makes everything more expensive. For example, that obviously shakes confidence with a big sell-off. You see the Dow down 2,000 points. That's going to unnerve a lot of people and get a lot of people afraid. That's going to dictate their behavior. You see interest rates move higher. You'll see rates across the platform move higher. That means mortgages, home loans, car loans, interest rates in terms of your credit cards. So if we see a market disruption tomorrow, then that's a different story. Yeah, it's not the chaos that you suggested, given the fact that these deadlines are a lot farther out. Having said that, it is chaos in the markets, and that tends to have a big impact because it will impact people's behavior. And it's sort of a vicious circle, because if I'm afraid because the market is plunging and I'm afraid what that means, maybe I'll pull in, I won't spend money, I won't buy big-ticket items. Companies will sit on cash, which they've been doing already. And it's sort of, it's a vicious circle. So it just worsens and worsens. So none of this is good, even though tomorrow is not the chaotic date that so many people have been talking about.
Let's listen briefly to what Treasury Secretary Jack Lew had to say, and then I'll get your take on that.
At the same time, we're relying on investors from all over the world to continue to hold U.S. bonds. Every week, we roll over approximately $100 billion in U.S. bills. If U.S. bondholders decided that they wanted to be repaid rather than continuing to roll over their investments, we could unexpectedly dissipate our entire cash balance. Let me be clear. Trying to time a debt limit increase to the last minute could be very dangerous. If Congress does not act and the United States suddenly cannot pay its bills, the repercussions would be serious. Raising the debt limit is Congress's responsibility because Congress and Congress alone is empowered to set the maximum amount the government can borrow to meet its financial obligations.
Your response?
Yeah, well, that's absolutely right. I agree with the Treasury Secretary. We should not be waiting until the 11th hour to make plans to actually to pay our obligations. That's true. But it's silly and it's getting goofy, frankly, that the two sides cannot just come together on an agreement on how to manage our debt and how to spend money in an appropriate manner. So I completely agree with what the Treasury Secretary is saying. I think one note that I would make is this rollover. The Treasury rolls over $100 billion every Thursday. And so that rollover debt happens because investors want the paper. They want to buy U.S. paper. And if we start seeing investors from all over the world say, well, I'm afraid the U.S. is not going to pay when the notes come due, then we are in a real hole. And we're going to have to come up with that money if the auctions are not working. So I think that this is important to mention the rollover debt. That's certainly a big portion of this story, and we don't hear a lot about it.
Writing in the Washington Post today, Zachary Goldfarb's headline, Markets Anxiety Builds as U.S. Credit Rating is Threatened. He notes that Fitch Ratings warned that it could downgrade the nation's credit rating by the end of the year if the showdown in Washington continues. Fitch would become the second major credit rating firm to strip the United States of its pristine AAA rating, which could have a ripple effect across a range of markets dependent on the U.S. government debt. Explain that for people and what it could mean for these global markets.
Well, I mean, as I was just saying, you know, it really is the market perception that may very well start to move people's hands, because last night, after the market closed, it was after the market closed, Fitch came out and said that they were reviewing the U.S.'s AAA rating and reviewing it with a negative watch. In other words, the next move would be an out-and-out downgrade of U.S. debt. And the issue there is when we do see a downgrade, we will see interest rates move higher because it's just less confidence in the U.S.'s ability to pay its obligations and pay its debt. So if we were to see a downgrade, I think that would create a market disruption. That's what we saw last time during the 2008 crisis when the U.S.'s rating was downgraded. And again, it's really about triggering the markets and the markets dictating behavior. Because as we just talked about, the actual debt payments are not coming due until the end of the month. And then, you know, really November 15th is an important date. Although November 1st, paying Social Security checks and government workers is obviously of high importance. But if we were to see the markets perceive something different and perceive that, okay, this is going down a bad road, this is actually, we weren't expecting this, because right now if you look at the markets, sure, we've had some down days, but it really hasn't been such a stunning reaction. Even though you've had a couple of days where the markets have been lower, Dow down 130 points or so yesterday, it's really not so significant because they're really fractional losses when you consider the fact that we've had a fantastic year in terms of equities and a fantastic year in terms of where bond yields are, enabling so many people to borrow and conduct transactions. So far, we haven't seen a real negative reaction. What that's telling you is the markets are betting on a deal. The markets are expecting Congress and the President to agree to a deal in terms of the debt limit of this country and in terms of extending the debt ceiling. Anything other than that would be a huge surprise for these markets. And if we were to see a big surprise, it would be a negative surprise, and the markets would sell off. And if that were to happen, as I mentioned, yields would spike, stocks would go down, and it would create a real moment of fear in the markets, and it would put a standstill attitude on people and on corporations that you have to hoard cash, you have to sit on cash, you don't want to spend money, you don't want to invest, you don't want to create jobs, you don't want to, put money to work anywhere. And nobody wants that because, as we know, 2/3 of economic growth is consumer activity. And that would probably tip us into recession.
I want to make sure we take your calls. For Republicans, the number is 202-585-3881. For Democrats, the line is 202-585-3880. And for Independents, your number is 202-585-3882. Maria, I want to get your take really quickly on how this is impacting the Asian markets. On CNBC.com headline, we're seeing Asian stocks cautious as Senate talks watch Shanghai skids over 1%. What are we seeing there?
Well, we are seeing some declines in Asia. Now, yesterday, after Fitch put the U.S. rating on negative watch, it did appear that the markets were rolling over and the futures were indicating a lower opening today. But that never happened, actually, because, in fact, things turned around fairly quickly. And actually, it was looking like a higher opening, and the market is looking like a higher opening in the U.S. Having said that, the nervousness of yesterday set the tone for Asia. And yes, we did see we did see declines in Asia. I wouldn't worry too much about it, but as I mentioned, if we were to see the market change its perception that, in fact, we were going to possibly face a default, we were going to extend beyond October 17th, beyond October 31st into November, then I would say the markets would react very negatively, and we would see a real dislocation in this market. Nobody wants to see that. So that's why I think the market is betting that that won't happen, even though fractional declines in Asia really not that significant.
Let's take your calls, starting with Elizabeth in Rockton, Pennsylvania. She's on our line for Republicans.
Hi, Marie. I watch you every single day on CNBC. I happen to be Elizabeth's husband, Vaughn. I'm a day trader, and I trade about 5,000 times a year. Can you tell me that the big sovereign wealth funds and big companies like Goldman Sachs aren't setting up through the algorithmic computer models, you know, just losing 100 points? That's nothing. You know, if the market was fearful, like you're saying, the market could be down 500 points. It's people don't have control of the market like these algorithmic computer models set up by the sovereign wealth funds and hedge funds. I mean, I was able to figure them out charting, and I go by exactly what the big boys do.
Go ahead, Maria, your response.
Yeah. Well, I think, you know, I think what you're saying is right. The markets are not expecting that we see a default. The markets are trading pretty well in the face of all of this, frankly, even though we have been seeing a couple of days of downward pressure. What you're talking about is electronic trading and algorithms, which some of the large institutions have set up. You know, why wouldn't you hedge your bets? I mean, why wouldn't you have a backup plan? I understand that, you know, the algorithms are very fast and probably, you know, seconds before some other players in the market, and these computer models are set up for any scenario. So sure, you will see a fast and furious move if, in fact, we were to see the government default on its debt. No doubt about it. I think I just said that. I mean, that's, you know, right now the markets are not expecting that based on what we're seeing, but I'm sure there are plenty of large institutions out there who have created models, as you mentioned, algorithms, that are set up to sell everything in a nanosecond if something goes the wrong way. And there's no doubt that some large institutions are having backup plans to do just that, which would accentuate any decline and make it that much uglier.
We do want to note for our viewers that markets in the United States are now open, and as Maria noted, they are beginning to open up, S&P above 1,700. Maria, given that, do you feel that there is any sort of disconnect between what we are seeing from Washington and what Wall Street believes will happen?
Well, Wall Street does not expect the U.S. to default. I would have to say I don't expect the U.S. to default. That would be extraordinary. And I think at some point, it is obviously going to happen in the 11th hour, we will see a deal materialize. And for the one reason that both sides are going to be under pressure come November 1st, you know, as we approach the end of October, both sides are going to be under pressure to pay the Social Security benefits, to pay government workers. They're not going to allow that to happen. So I do not think we will see a default. I think that's probably the feeling of the market and why we're seeing gains. People are looking at the market and saying, okay, as soon as the deal comes out, this market will probably rally. I want to get in before that. So I don't think there's a disconnect. However, I do believe that all of this back and forth, this fighting, this inability to get anything done in Washington is damaging the reputation of America. It is damaging the reputation of the country's leadership and credibility. And that's sort of a long-term chip away, chip away, chip away kind of story. So will people say around the world, well, I don't want to invest in America because of what's happening today? Maybe not. Maybe not, because the corporate sector is doing very well. There's an enormous amount of cash on balance sheets, and actually companies in America right now are among the healthiest in the world. The problem is they're sitting on that cash. They're not doing anything with it. They're not investing in it. They're not creating jobs because they're afraid of what's around the corner, and it's just smarter and more prudent to just sit on cash and have the wiggle room. But over the long term, if we have a reputation of having an inability to get anything done, that leads to a reputation of failed leadership. And the U.S. is really still the leader in terms of the global economy. You don't want to lose that, and we cannot become complacent. So this is very important. So I don't think that investors globally are saying, I'm giving up on America. I think it's still a very attractive place to invest, and I think that is the case and will be the case. But as we chip away at our reputation, there is a price to pay for that. So over the long term, that may very well be a situation where people say, okay, America is okay, but I also like investing in Latin America. I also want to put money in Brazil, in Mexico, you know, in Japan, which is getting its own financial house in order as we speak. So, in China. So I think it's very important to recognize that there is a price to pay for the chipping away at the reputation and leadership of this country.
Next, let's take another call from Randy in Smock, Pennsylvania, on our line for Democrats.
Good afternoon, Marie. Or good morning, I should say. You once said that the main thing that Wall Street likes to see is calmness. That being the case, how can the public, Joe Sixpack out there, have calmness when Wall Street doesn't seem to mind fluctuating oil prices like a seismograph on an earthquake, during an earthquake? We're supposed to show Wall Street calmness, but they never show us the same. Thank you.
Thank you, Randy. I think that you've got two different kinds of investors out there. You've got the long-term investor, and you've got the short-term day trader. So the long-term investor should absolutely exhibit calm. The long-term investor should be looking at 5, 10, 20, 30, 40 years in terms of having your money in the markets. And if you really do want to look 30 years from today, or if you're looking even 10 years, 15 years from today, you have to believe that the most attractive place for wealth creation is investing in equities. Yes, you have to have a diversified portfolio, but investing in equities over the long term, over history, has always proven to be a wealth-creating mechanism. You're investing in American companies that have exposure all over the world, that are growing earnings, growing revenue, and creating jobs. That is the long-term story of investing, and that is a smart story for the long-term investor. And I think in that regard, you have to ignore all of the noise, and there's a lot of noise around all day long, but you've got to ignore the noise over the short term, and you have to look long-term and ask yourself, has anything changed with this company that I'm invested in? Has anything changed with this industry that I'm putting my money in? Has anything really changed in terms of the attractiveness of the U.S. economy over the long term, not short term? That's how you invest long term, and that's why you need to stay calm. The short-term investor is very different. The short-term investor is trading, as you just heard our first caller, trading massively, very quick, trying to make a buck on gaps in trading, buying at 5 o'clock, buying at 9 a.m. and selling it at 9:30, buying at 10 a.m. and selling at 10:15. That's the, or even shorter gaps than that. That's the short-term trader. And the short-term trader has a role in this market. There are short-term traders. Now, back in the 90s, there were a lot more day traders and short-term traders during the dot-com era. So some of those day traders have gone away. But there certainly is a role for short-term, knee-jerk reaction and day traders in this market. And they don't have to show calm. So I think as a long-term investor, you have to decide who you are. if you're a long-term investor or if you're a day trader. I am not a day trader. I would not get into that business because it seems to me that it's very risky. You really have to know what you're doing. If you are a long-term investor, I think it's very prudent and very smart to stay calm, to know that we're living longer. The demographics of this country show your children may very well live to 100 years old. You really want to have the money that you need for retirement. And in order to do that, you need a long-term plan, which definitely involves owning equities.
Next up, let's hear from Chad in McLean, Virginia, on our line for Republicans.
Yes, good morning, Maria. First, I'd like to say, the problem with the immigration bill, as a Republican, I do believe that immigration would bring about $1 trillion of revenue into the system over 10 years. And I think that, the Republican Party of new, not the Republican Party that I grew up in, has to get over all the arguments over the problems of immigration and look at the prosperity.
Chad, did you have a question about the financial markets today?
Oh yeah, I believe it's a great buying opportunity. This downturn, because the fundamentals are great, and Warren Buffett said this morning that he would be definitely buying in this market even if it dips, because it's definitely going to come back as soon as everything's fixed. So thank you.
Thank you. We'll go on to the next caller, Danny in Nashville, Tennessee, on our line for Democrats.
Hello, Maria. Thank you for taking my call. I'm a first-time caller, but a long-time viewer. I have a simple question, a common sense question about the budget thing. The House and Senate, they know that every year a budget has to be passed, but it seems like that every year they get to the so-called 11th hour before things are reached. Now, I'm retired. I'm on Social Security disability income, and I'm actually scared that my benefits are going to be interrupted. But I think that using common sense, as we do in our own household budget, would be the better ideal way for the House and the Senate to do this than to wait to the 11th hour. Thank you for taking my call.
Well, you're absolutely right, and I 100% agree with you. You know, I grew up with a mother who always saved, and didn't spend beyond her means. And, you know, these are very basic tenets. These are very basic things that we all know and we all follow in our own lives. Unfortunately, we have not had a passed budget in government for 5 years. 5 years we've been operating without an official budget. It makes no sense. And unfortunately, as a result of that, that's where we find ourselves today, fighting. If we had a budget for the last 5 years, perhaps we would not be in this pickle. So I completely agree with you that we need to get our financial house in order. Unfortunately, we're doing so at a time that we need to make decisions about raising the debt ceiling. This is not necessarily the time to be planning our budgetary moves. We should have had a budget in place for the last 5 years, and we haven't. So here we are facing an important deadline and making these decisions in a rash way, which is, as anybody who runs a household or anybody who runs a business knows, that's not the way to plan your finances. So, you know, you could look at government and think, oh, you know, this is big government, this is different, this doesn't apply to me. That's not right. That's not true. In fact, all of us know how to budget. Most of us know that we can't go on in our lives with just spending willy-nilly and not knowing what we're saving and not knowing what we're spending and how much money's coming in and what's going out, and using blunt objects, you know, to just say, okay, don't spend there, and what I'm referring to is the sequester. So in other words, for the last 5 years, the failure of not passing a budget is basically leading us to where we are today. I do think that has a lot to do with where we are today, the fact that we've been unable to agree on a budget for 5 years. It's just extraordinary.
Maria, should the average person be concerned about their 401ks or their investment portfolios right now?
Well, you know, 401ks and investment portfolios so far have performed very well. And over the long term, as I mentioned earlier, I suspect that they will perform very well. You cannot trade your 401k or your investment portfolio if you're a long-term investor. What I always believe in is saving and investing for the long term wisely. That means a diversified portfolio. That means, depending on your age, will dictate how much you want to have in equities, how much you want to have in fixed income, real estate, alternatives, commodities. There are very many asset classes to have exposure to. No, I do not worry about long-term 401k plans and investment portfolios because I'm a long-term thinker. And I think at some point we will get an agreement in Washington and things will stabilize. If you look at the corporate sector right now, it's doing very well. I think it's about $3 trillion of cash on balance sheets. Earnings have largely been okay, although the earnings estimates are coming down a bit. And revenue has been slow growing. We're waiting to see real revenue growth, which we haven't seen. That really indicates end market demand. So it's important to see revenue growth, which we haven't seen. But having said that, for the most part, companies today are doing well. They have learned lessons from the 2008 collapse. They've gotten lean and mean. That means they've laid off workers. They've cut their spending. They have really improved their balance sheets. And so they are much better positioned today than any time in the past. There are issues. The regulation has been incredibly expensive. That has created some flies in the ointment. But for the most part, companies today are doing very well, and your 401k is invested likely in American companies, and so I'm not worried about it. But certainly over the near term, we may very well see a big sell-off in stocks. Over the near term, if we don't get a deal done in Washington, many people I speak with would see that as a buy-on-the-dip mentality. They would buy any weakness. I would not be surprised to see a big market sell-off at some point if we don't get a deal agreed upon in Washington and as we approach beyond October 17th and toward the end of the month. But again, because I'm thinking long-term, I wouldn't worry about that sell-off.
Continuing our conversation with Maria Bartiromo. She's the anchor of Closing Bell with Maria Bartiromo on CNBC. Let's go now to Jerry in Los Angeles, California, on our line for Republicans.
Good morning, Maria. Great to speak to you. I was just calling because all of this discussion about raising the debt ceiling centers around, and even you're saying it this morning, talking about default. And you know, Maria, and Moody's published this publicly the other day, that because you don't increase the debt ceiling doesn't mean that the United States would default on its debt. We have plenty of money to pay the debt. But what it may do is cause the United States to prioritize our expenditures. And the interesting thing this morning I'm hearing from you, and I heard it started creeping in yesterday, that while the scared tactic is that, oh, the deadline's Thursday, we got to get it done by Thursday. Well, now, oh, well, maybe it's November, because people really know that increasing the debt ceiling does not mean you have to stop paying your bills, and there's plenty of money to do so. Then you had the specter of the Treasury Secretary. I don't know if it was last Sunday or the Sunday before, the Treasury Secretary of the United States stating publicly that the United States was unable, could not, or would not prioritize its payments. So, yes, indeed, if you didn't raise the debt ceiling, it would cause a default. So I wish you would comment on that, and I wish as a financial commentator that you would be more factual, I guess, in your statements rather than fear-mongering that we're not raising the debt ceiling will cause a default.
Yeah. Well, I mean, I think it's clear to many people that, you know, what the payments are. We do have a deadline on October 17th because Jack Lew put that date out there. Because there is a debt payment due. It's a small and manageable one, but you're right. That's not the main date. The bigger date and more important date would probably be November 1st, when the non-debt obligations are due. That's government workers and Social Security payments. And then November 15th, when the $30+ billion in debt payments is due. Look, I think the point of all of this is we could, pick hairs about October 17th or October 31st or November 15th, but we're here, okay? We're a couple of weeks away. I don't know that it's very healthy to be living life on the edge and to be, living life, okay, where there's $30 billion left. Okay, now there's $5 billion left. It's just, this is America. And, the confidence in the country is critical to ensure further investment and foreign direct investment in the country and so many large holders of our paper, our bonds around the world. So I think the real point is that we're getting there, and we're here. It's time to come together. And so, yeah, you're right. You don't want to have, house on fire reporters running all over the place saying, chaos, 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 and get everyone unnerved. I totally agree. We need to look at this calmly, report the facts straightforwardly, and not put emotion in there to trigger bad behavior by viewers or anyone else watching. Having said that, the time is now. We may be a couple of weeks, it may be 2 weeks or 3 weeks, and not a day, but it's time. And I think the American people are so frustrated with the fact that our leaders can't agree on anything and have such vitriol for one another. I don't know, maybe it's just time for both parts of government to be replaced. I mean, to get people in there who will actually bring people together to lead and to come to solutions, because we can't continue this way. You're right. It's bad to be, emotional and to scream and, have hot heads about this, but it's pretty clear that we're in the neighborhood of, yeah, it's time. We've got to come together now. We've got to come to an agreement on how to govern the country, how to spend money, and how to ensure that the country, all of us, are prospering.
Let's go next to Greg in Antioch, Tennessee. He's on our line for Democrats.
Hi, Maria. I appreciate you taking my call. My biggest question is that since we are the people that put these people in Congress, I think it is a shame that we, as a people, cannot vote them out if they cannot do a job. I mean, they should have it to where we can say, all right, if you're not going to do the job, we're going to get somebody else in here. This is ridiculous. This is the second close down of the government that I can remember, and it doesn't make no sense. I mean, it's like if I go to a job and I say, they tell me to clean the bathrooms, and I say, well, I ain't going to do that. They're going to fire me. And I think that should be the same thing.
Thank you, Greg.
Well, you'll have an opportunity in 2014 to vote some members out. You'll have an opportunity in 2016 for the president. So that's what our country is all about. You will have your opportunity.
Next, let's talk.
You just can't do it right now.
Next, let's talk with Mike in Brentwood, New York, on our line for Independence.
Hello.
Morning.
Oh, good morning. I just have a question. Why don't they just cut spending 20%? Cut Social Security 20%, cut Medicaid 20%, cut the vets 20%, cut Congress 20%. They cut everybody 20%, we'll be operating where we should be operating. Then we won't have such a problem. That's the budget right there. I don't see what the problem is with that.
I love it. You've got to get a job in Washington. Listen, you're right. I mean, some of these questions and sort of, head scratchers, you have to say, well, what's the problem? If we know we're running out of Social Security, why don't we just cut it? If we know we're the most expensive country in terms of health care, how come we just don't cut it? I mean, it seems so obvious, but unfortunately, this is something called politics. And in politics, people do not want to have it on their watch. Oh, he's the guy who cut my Social Security benefits. Oh, yeah, she's the gal who cut my health care insurance. And so in politics, nobody wants to be the one to cut your benefits, and that's what the problem is. And so, yes, you're absolutely right. And by the way, we've been talking about tax reform forever. How come we don't just reform the tax code? Well, because nobody wants to be the one to say, I raised taxes on you and I cut taxes on you. And now you're not going to vote me back in, and you're going to not vote me back in because I cut your Social Security benefits. It's politics. It's not leadership. And that's the biggest problem. What you've just hit on is probably the single biggest issue. We have so-called leaders in Washington politicking, not leading. So what we really need right now is some leadership. We need someone to take the lead and say, this is unsustainable. Unfortunately, this has to be changed. And this has been in place for decades and decades, and I recognize you've been enjoying this, but unfortunately, this country can't afford it anymore. So we have to reform this program. We have to change this program. And nobody wants to do it. They're afraid because they're not leading. They're politicking.
So it's a little bit before 10 a.m. here on the East Coast. We're keeping an eye on the markets. The S&P still over 1,700. Dow Jones Industrial Average up 148 points. What does that tell us, do you think, Maria?
That tells us that investors are betting on a deal. They are betting that the two sides come together today and avoid the October 17th deadline. It tells us that earnings are coming in better than expected, that investors are pleased with the current earnings period, and it tells us that America remains the best house in a tough neighborhood in terms of the globe. And at the end of the day, there are very few alternatives to investing in American companies that are growing earnings, growing revenue, and rising cash levels, providing for great wiggle room. Mostly it tells us, because it's one day before this deadline tomorrow, that investors are betting on a deal. They're betting that something good happens today. We'll see.
Let's talk now to Terry in Minneapolis, Minnesota, on our line for Republicans.
Hi, Maria. How you doing?
Great.
Hey, my question is this. First, a scenario followed by a question. Say Obamacare needs young, healthy adults to sign up and pay in to offset the over expenses of the already pre-existing conditions. My question is this: expecting the 20 to 35-year-old healthy people to sign up and pay more with high deductible policies when pre-existing conditions don't matter, why would any young person sign up for that plan? Why wouldn't they do what I think they're going to do, is just wait till they get sick and sign up? Got cancer? Sign up. Get the premium plan, get the lowest deductible, and pay from there. And here's my real question. When that happens, which I think it will if you look at all government programs, including Social Security, where pretty much everybody believes or knows on disability that 30 to 40% are fraudulent claims, just an extension of unemployment. So when they start gaming the system like that, which it's going to happen, what's going to happen? Are we, the rest of the taxpayers, going to have to put more money in to support Obamacare? And what will that do to the debt ceiling at that time? Thank you very much.
Well, taxpayers will pay for it. I believe it is the law. You have to have health insurance. And that's one of the fights going on in Congress right now, because the Republicans would like to put the mandate that forces individuals to sign up to buy health insurance. They would like to put that off for a year or even 2 years, the way that the mandate has been put off for companies. But the Democrats are saying we don't want any change to Obamacare, and we're not going to operate with a gun to our heads. So this is the fight right now. But I do believe that at this point it's the law, and individuals will have to sign up for it. And whether or not you end up paying for it is a question. I think, yes, taxpayers ultimately will carry the burden of this.
Maria, I wanted to get your take real briefly on the selection of Janet Yellen to head the Federal Reserve.
Well, I think, Janet Yellen has been the vice chairman of the Fed and has worked with Ben Bernanke for many years. And it will likely be a continuation of the policy that we've seen out of Chairman Bernanke's leadership. That means more stimulus. Well, not necessarily more stimulus, but the stimulus continues, that $85 billion a month. You know, some people were expecting tapering, of course, last month, and we didn't get a tapering of the stimulus plan because the Fed basically felt that the economy wasn't ready for the Federal Reserve to leave. The big frustration within the Federal Reserve is the lack of fiscal policy. The Fed is feeling like it's all on its back to stimulate the economy because you're not seeing things like tax reform, where you could see corporate taxes move lower, enabling corporates to hire and create jobs. So, yesterday on the closing bell, I spoke with the Dallas Federal Reserve President, Richard Fisher, and he would like the tapering to begin. He would like the change to begin in terms of rolling back this stimulus. And he continues to say that it's not fair that it's all on the Federal Reserve, that we have seen a real absence of fiscal policy. Again, an absence of leadership, no fiscal policy. It's all Federal Reserve monetary policy. But that's where we are. I think Janet Yellen will continue the policies of Ben Bernanke. I think she is a person who brings people together. She's been talked about as being someone who listens, and it's not, her way or the highway. I think that was one of the criticisms, actually, of Larry Summers by some senators, and that's why he had to withdraw his name. I like the fact that she's a local girl that's done good. She's actually from Bay Ridge, Brooklyn, where I hail from. I think she's very accomplished, and I think
Maria,
it will be
unfortunately, we're going to have to leave it there as the House is now coming into session. They're meeting this morning at 10 o'clock for morning hour, 12 o'clock for legislative business.